Hello, good evening, everyone. I'll be sharing our fixed income outlook of our fixed income team. Uh, I'll begin with the global macro, it will be followed by Indian macro, and then Sunana will be taking the credit part of the deck. To begin with, if you have to just analyze where we are currently, we have to step back a little bit to see what happened in the last 2 years, because a lot of unique things happened in the last 2 years, and which are a key reason why where we are standing right now. So COVID was a very unique recession, a sui generis recession. So typically, if you look into a recessions, we have typically 6-8 quarters of downturn, and then again 6-8 quarters of upturn. But this COVID recession, it was a sharp recession. In 2 quarters, we reached the trough. In the next 2-3 quarters, we're already now back to the pre-COVID levels. Again, it was the broadest recession in terms of number of economies which went into recession. Largest ever number of economies went into recession. In terms of GDP degrowth, we had the sharpest degrowth since the World War II. But again, another unique thing about this recession was that throughout the recession, we typically keep on getting negative data surprises. But in COVID, almost through the entire pandemic, the data surprises kept on being very, very positive. Reason for that, number one, aggressive rate cuts, the monetary policy. The policy response to the recession was quite phenomenal. Monetary policy came out with a bang. We had aggressive rate cuts across the board. You look into any major EM economy, the rates went sharply lower and much lower than what they were in 2008 global financial crisis. Also in DM economies, they straight away went to zero. Rate cut for the first part. The second was aggressive quantitative easing. Balance sheet zoomed across the board. Much higher than what we had in the global financial crisis. Closer to $10 trillion of balance sheet expansion took place in the last 2 years only in the G5 economies. The result of that, we had a booming monetary policy, booming money supply pretty much across the board, and again much higher than what we had in the global financial crisis. The fiscal was the first part. The second part was in terms of the monetary was the first part. The second part was fiscal. Aggressive, very, very aggressive, I would say, fiscal policy response. So I'll just give an example of United States. For every 1 unit of GDP loss, the amount of fiscal stimulus that was given was 3 times. That was the level of fiscal response that came out. Global GDP went up by 4% point just because of the fiscal stimulus. How it differs much more than from the global financial crisis, the fact that in global financial crisis, immediately after crisis, we had a sharp fiscal contraction, but this time it appears that that the fiscal contraction is again going to be a very gradual affair. So net aggressive monetary stimulus, aggressive fiscal stimulus, and a lot of it persists. The result of that, potential gap closed very, very quickly. Again, have this reference of global financial crisis, how gradually the potential gap closes. This time, almost pretty much across the board, we had sharp closing of potential output gap. And market rallied pretty much across the board. Global equity markets had the best runs in many, many decades. Household wealth linked to both financial assets and non-financial assets zoomed pretty much across the board. In a country like US, household wealth zoomed by up to 80% of their GDP. Same with similar big jump in household wealth also in Euro area, UK, Canada. Also, a lot of the fiscal stimulus which was given was largely saved by the households, and the result of that was that household saving also, rose across the board. So household balance sheet improved dramatically. Consumption, if you have too much of money coming out, a lot of it free, consumption zoomed pretty much across the board. You look into US, significant jump in consumption. Look into Euro area, again, very strong jump in consumption. Pretty much similar story was there in many of the other DM economies also. Global unemployment rate fell significantly and quickly went down, below the pre-COVID level and also below the, in a very, very long time. The result of that was that we had big jump in inflation. You look into DM economies, EM economies, globally, everywhere we are seeing a big jump in inflation. If you look into this graph, the graph shows the percentage of economy which are having inflation greater than 4%, and see this wallet graph, big jump over there. So pretty much sharp uptick in inflation, not only in terms of intensity, but also in terms of breadth. So pretty much everywhere we are seeing pretty high inflation. Now the current scenario is that the key market of the reserve currency US, the job market is red hot. For every 1 unit of loss of, for every 1 person looking for a job, there are 1.7 vacancies available. So wage growth has been spectacular over there. Unemployment rate has also fell sharply. Just to give an example, give an instance, So there are only 3 months in the last 50 years when US unemployment was lower than what it is right now. And that is, 2 months in, 2 months ago, we had this sharp recession. So that was that just reflects the ferocity of the, pickup in growth that we are seeing, that we saw particularly in US. Fed fell significantly behind the curve in the sense that inflation went up very sharply. Growth was pretty strong. If you look into the real policy rates, they are the lowest ever in the last 50 years. So, just look into this green line they show, but where are the Fed rates and where is the inflation? And there's a big gap over there. If you compare with the Taylor rule, the current rates current US Fed rates are 7-8% lower than what they should have ideally been. Similarly, in the ECB, I think they also much behind the curve. Inflation has zoomed also in ECB throughout the Eurozone, and even in conservative economy like Germany, where we are seeing closer to 8% inflation, Spain very high inflation, and again, if you look into real policy rate, deep negative over there. And just a few months ago, they were even in this high inflation, they were also increasing the balance sheet, just to show how far behind both these big central bankers have fallen. And if you think these were the only two central bankers, no, have a look into broad spectrum of central banks across the world. Real policy rates are pretty much negative in most of the major economies. Look into Argentina, Brazil, pretty much everywhere. In India, they're also again negative, but a little bit less than what they are. What's the median negative real rates? So, because central bankers are much behind the curve, the markets are pricing a very aggressive catch-up. Pretty very aggressive rate hike is being factored from the US Fed. Even if you compare from January, but in January, markets pricing of Fed rate hikes have gone up by closer to 200 basis points. It's very rare to see in an economy so well covered that market expectation of rate hike goes up by 200 basis points in less than 3 months. So a big jump up in market expectation of rate hike, not only in US Fed but also in ECB. Again, from a central banker as dovish as ECB, now markets are factoring closer to closer to 200 basis point of rate hike in the next 2 years. So that shows how much catch-up market thing is going to happen across central banking space. And not only in terms of rate hike, but also in terms of balance sheet contraction. Also, yesterday we had this Fed minutes, and that showed that Fed is now planning to reduce their balance sheet by close to $1 trillion per year. That's the level of monetary policy tightening that is due in front of us. The result of that has been that yields have surged pretty much across the board. Looking at DM economy, bond yield, big surge. Same for EM economies. And what we're also seeing is that a pickup in bond volatility. So because markets were caught, I would say both central bankers and markets were caught unawares in terms of this inflation flare up. Therefore, there's a big cash up happening in the bond markets. Now let's come to the Ukraine crisis, a very proximate thing for us. In terms of its impact, number one, its impact on GDP. World economy impact is expected to be little above 1% of percentage point of GDP. The impact will be mostly in the euro area and somewhat lesser in non-euro area economies, simply because the connection of euro area has with Russia. In terms of inflation, its impact is likely to be significant at 2.5% across the world. Now, the thing about Russia is that Russia is not a very major economy globally. It only accounts for, Russia plus Ukraine totally accounts for around 2% of the world GDP. But in terms of its, commodities, they are a very, very big players. You look into all the rare earth metals, energy, both oil and gas, wheat, agricultural products, wheat, sunflower oil, fertilizer. They are very big players over there. So the result of that, we are seeing a big surge up in commodity prices. They have reached the highest level in a very, very long time. Also, food prices have surged pretty much across the board. Crude oil, we are already, a lot of media coverage of that. It has also surged significantly, same with the natural gas. Again, in terms of exposure to Russia, most of the exposure is for euro area, except for, those markets which are more global in nature, for example, the commodity markets. However, despite this big surge in commodity prices, in terms of the financial impact, the financial stress indicators suggest that the level of financial stress which this crisis has caused is significantly lower than what we had seen in the other major crises. So some stress is there, but it's still broadly contained. You look into VIX, which is the indicator of equity market volatility. It is pretty well contained. You look into credit default swaps. It has risen somewhat, but not significantly. And EM's financial stress indicators have risen somewhat, but still quite less than what they were in beginning of COVID or in many of the past crises. So the financial stress has been quite muted. Now let's come to the pandemic. The pandemic is varying pretty much across the board. We are seeing sharp fall in cases, except for China, where we are seeing a big jump in cases. If we scale it, the numbers are quite low compared to many other economies, but still, because China follows a zero COVID policy, so that's a big worry. This chart shows the level of risk aversion which different economies have to COVID. And here, China, Singapore, all these, and South Korea, these economies come right on the top, which means that even the small jump in cases in COVID cases in China can have some impact on global growth and global supply chain, because China is such a big player. We are already beginning to see this impact of zero COVID policy of China. There, if you look into the PMI data, it has fallen sharply, both the services PMI and the manufacturing PMI. And if you do a cost-benefit analysis of how China has fared through this pandemic, so in the initial 2 years, the sense is that China's zero COVID policy, because it was able to contain the pandemic, did net it was a positive for the global growth. But what we are seeing right now is that at this juncture, this Chinese zero COVID policy is likely to be negative for their growth in the world economy. So that's one thing you have to contend with. That broadly, the pandemic is now waning pretty much across the board. But China is one economy which will have some more, which will have this impact going on for some more time. Coming to India, so compared to the global policy, we have discussed how big surge in how big monetary fiscal stimulus was given. In India, it was much more modest. You look into the RBI balance sheet, it did rise, around 4% of GDP and went to the highest level in a very long time. But still, you compare to the other major economies, it's a pretty modest increase in the RBI balance sheet. You also look into the government fiscal stimulus that were given at 3.5% of GDP, much lower than the DM average of 17%, US value of 25% of GDP, and just closer to what we had as the EM average of 4.1% of GDP. So in terms of the policy response to COVID, we were much more moderate, you can say much more conservative, and and this result was that the recovery that we are seeing is also much more modest compared to what we saw in most of the DM economies. So last year we had this growth uptake of 8.9%. Now, but don't get confused with this high optical number because we had this very strong base effect in last year and also in this year. So a better way to look into the GDP growth is compare it how GDP growth could be on a CAGR basis compared to FY20, where most bases are not there. And there we see that in FY23 we are on the more bullish side in the spectrum, but we also think that India's GDP growth is likely to go up by only 3.5% if we remove all the bases. Obviously, the headline number will be closer to 9% is the view. There are some downside risks to that, especially we are assuming that this the hot part of this Ukraine crisis will go away in a couple of months, while the sanction, etc., can linger on, but we can be wrong there. And if this crisis the hot crisis lingered much longer, then we can have some further downside to GDP growth. However, if we compare how this India's growth is faring compared to the pre-COVID trend, we are still around 7% lesser than what we were in the pre-COVID trend. In economies like US, we are already back to the pre-COVID trend. So that's one thing to keep note of. The good part is that recently, because COVID is waning up, we are seeing a big decent jump in economic activity. And the big reason for that is that the pandemic has subsided significantly. If you look into this is the this is a lockdown index. It's a globally cross-country index which tells you what is the level of COVID restriction that we are having. So India's COVID restriction are now almost closer to zero, which is we are almost back to the pre-COVID levels in terms of restriction, and that is showing in the plethora of all these high-frequency indicators showing a decent uptick. Within the economy, we are seeing somewhat of a K-shaped recovery. The organized sector is doing much better. You look into the payroll additions, you look into the EBITDA of listed companies, the companies which RBI tracks. You also look into the credit ratio, the upgrade and downgrade. All are showing that at least the organized sector is recovering faster. That this also reflects in the very decent, robust tax collections, which have grown. The 2-year CAGR of the tax collection have go to the highest level in more than a decade. So in the previous slide, we discussed how India's growth is still 7-8% below the pre-COVID trend. But if we look into tax collection, we've already gone above the pre-COVID trend. A lot of it is because of, I think, better compliance. If you just look into GST, the percent of GDP, GST collection, the percent of GDP, we are now steadily improving. So both a result of, I would say, greater formalization, improvement in GDP growth, as well as better compliance resulting in decent tax collections. The flip side for India is that the consumer confidence is very low. Over the last 7 years, so we had 3 stages of India's growth. In the first stage, we had big jump in fixed capital formation, as well as decent growth in consumptions. Same was the case in the second leg. In the third leg, since the last 7-8 years, most of India's growth is coming from the consumption side. And here, the problem is that if this consumer confidence remains so low, it will be a drag on India's growth recovery. Having said that, we do expect this consumer confidence to recover gradually as COVID drags, wanes, but it will still take some time. And that's the result. That's the reason why we are also penciling in a more modest GDP uptake from the current levels. However, conditions are quite good for capex revival, but capex typically follows consumption. So we, while the supply side of capex revival are quite strong, industries have deleveraged, banks are sitting in a lot of fund, banks' capital adequacy ratio have become quite decent. Companies have also raised a lot of funds, but the problem is that with consumption so on the weaker side, it will take some time for the capex revival to play out on the economy. Other important fact, data to ponder for us is the inflation. Inflation pressure in India has remained quite elevated. It is somewhat lesser than what is there in the DM economy, but still, at closer to 6%, India's inflation is very uncomfortably close to the RBI's target band. Also, inflation expectations by household, which is a good indicator of inflation coming ahead, still remains quite elevated. If you look into, firms' input prices versus output prices, we see that there's been a big jump in input prices of firms, which again means that output price pressure will remain elevated in the forthcoming future. So inflation is one concern that economy is currently facing. On the positive side, our food stock is quite abundant. If you compare the food stock compared to the buffer norms, we have significantly, 4 times the buffer norms in terms of rice and about twice in terms of wheat. So earlier we discussed how the Russia-Ukraine crisis is resulting in flare up in commodity prices, also in flare up of food prices. But because India has decent buffer stocks, so the immediate impact on India is likely to be somewhat muted, except for a few commodities where we are big importers. For example, palm oil, generally oils, we are a big importer, and Ukraine is a big exporter of sunflower oil. And secondly, I would say pulses is another segment where we are big importer. Otherwise, because our buffer stock is quite strong, we don't foresee a big sharp jump in India's food prices because global prices have gone up. Having said that, the problem is that whenever we have this big jump in commodity prices, big jump in fertilizer prices, the input prices of the farmers go up. And as you can see here, farm input prices have gone up significantly, and this flows into the MSP prices, which government sets. So while the direct linkage of this rising global commodity prices won't reflect immediately into India's food inflation, but over time to this channel of MSP, this should start having impact on inflation. So net inflation pressure are elevated, and they remain a risk to watch out for. For India, the impact of Ukraine comes from, one, most importantly, from petroleum trade deficit, petroleum crude oil. We expect, so all this calculation is assuming $100 per barrel crude prices. In that scenario, we see a big jump in India's petroleum trade deficit from closer to 2% in FY21 to 2% higher, closer to 4%. That will have a big impact both on the CAD level and also on the monetary policy and the GDP. That's one segment. The second one, is in terms of fertilizer prices, which have gone up significantly. And India imports a lot of fertilizer. And well, government has promised that they will keep the fertilizer prices stable, which means that it will have a big fiscal impact. In terms of direct impact of global food inflation, as we see, except for edible oil and sugar, in most other segments, food aggregate, India's correlation with global prices is not that strong. So, global food prices will not impact India overall, except for certain segments. However, there's some impact is going to come via FII flows, which have already turned negative. That's one segment which is going to have a negative impact. The second one, as we know from FII, we know that external account will be under some pressure. We are already seeing, because of higher crude prices, we're already seeing big jump in India's trade deficit. And we expect that India's CAD is going to go up to around 3.5% of GDP, which is a significantly high number. India's comfort level is around 2.5% of GDP. So that's one source of problem for India. So for India, the external account is a debate between the flow and the stock. Now, while the flow has actually turned quite adverse, one can say. But the good thing is that over the last 2-3 years, RBI have been accumulating a lot of reserves, and India reserves are quite significant. And they will ensure that we don't have any run on the currency like we had in the taper tantrum or toward the GFC. So while it means that we can hold on to this higher CAD for some more time without causing any big macroeconomic stress. Just just to compare where we currently are compared to the global financial crisis, just have a look. In terms of current account, we are significantly worse. In terms of overall BOP, we are somewhat worse. But now this is very interesting. So now we have discussed that India's real rates are quite negative. A lot of people are complaining India's real rates are quite negative. But what matters for the currency, for the BOP, is that how India's real rates are compared to the US real rates. And here we see that we are significantly, if we do a differential of Indian versus US real rates, we are significantly positive compared to the US real rate, which should result in FIIs not leaving India in bulk. So that's one positive thing. Second, as we had discussed, that FX reserves in India are quite comfortable. So net, some source of concern, but no, I don't think it's a outright big concern as of now. But if this if this pain persists for some more time, a few more quarters, then I think some big correction in currency or other macroeconomic parameters will be required by the central bank and the government. Okay, now what we are seeing is that gradually a credit growth which has been quite low for quite some time has begun to pick up gradually. Why it is important for fixed income investors is that because there's a very strong correlation that incremental credit deposit ratio has towards with the 10-year G-Sec yield. So this rising credit growth is one factor which we need to look very carefully in terms of its impact on the India's bond yields. Now, the bigger concern for India in that bond market has been that there's a big supply of paper which is coming from the government. There has been a big jump in fiscal borrowing. Government deficits have been quite elevated for the last 3 years. And this year, in the first half, government has planned to borrow 8.5 trillion rupees. Now, compare this to the total borrowing in FY20, FY19. The total first half borrowing is more than the borrowing that we had seen in the pre-COVID region. So the overall borrowing has gone up by around 2.5 times from pre-COVID region. There's a lot of supply of papers. To be fair, this supply was there in the last 2 years also, but in the last 2 years, there was ample RBI support. Closer to 30%, 20% of overall papers were bought by the RBI itself. This time, because the liquidity in the system is very high and because inflation concerns are there, growth is much better than the last 2 years, RBI support is likely to be somewhat less, and that will have its implication on the bond markets. And that is the reason why rates are going up. So real rates in India, as we have discussed, are quite low. Significantly lower compared to the I would say this current RBI regime has resulted in a sharp fall in India's real policy rate. Pretty much across the board, you look into weighted average lending rate, deposit rate. Everywhere you can see that rates have the real rates have gone down significantly. And that is the reason why markets think that RBI is also much behind the curve, and they are pricing in a very aggressive rate hike cycle from RBI. In the next 1 year, if you look at the swap curve expectation, they expect rates to go up by around 200 basis points. So there's a pretty steep pickup in rates which markets are factoring in, and that is the result. And that is resulting in a very steep yield curve in India. Now the point to note for bond investors is that a lot of this hawkishness is already in the price, already in the yield curve. And our base expectation is that the actual rate hike from the RBI is likely to be much lower than what markets are already factoring in. And that's an opportunity for the fixed income investors. Now, this is one golden rule of bond investing is that this is for the US market, but it's pretty much same across the world. This says that if the rate hikes or if the rate action by the central banks are lesser than what markets are factoring in those periods, fixed income give better returns compared to the staying in cash. And in periods where central banking rate actions are much more hawkish compared to what markets were factoring, it's only in those periods that fixed income gives worse returns compared to staying in cash. And as we discussed here, RBI rate hike expectation already very steep. RBI governor has been, went out of his way to say that they will ensure a gradual, withdrawal of monetary policy accommodation. And therefore, I think there's a lot of opportunities available for fixed income investors, depending on their time horizon, to have a suitable point in the curve and invest in the markets. I think I will end here. I think next to Sunena.